Good afternoon, ladies and gentlemen, and welcome to the ACCROL Group Holdings investor presentation relating to the final results for the year ending 30th of April 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your InvestorMeetCompany dashboard. I'd like to also remind you that this meeting is being recorded. Before I begin, I'd like to submit the following poll. And I'd now like to hand over to Gareth Jenkins, CEO, and Dan Wright, Chairman of ACCROL Group Holdings. Dan, thank you very much.
Thank you, Mark. Welcome everybody to ACCROL Group's FY19-20 results presentation for the year ended April. Welcome to you all. It's the first time we've done this event, but we hope to make this commitment to private investors to make it an ongoing thing. So welcome everybody. I'm Dan Wright, I'm the exec chair. I've been in place alongside Gareth for about 30 months now. Leading the turnaround alongside him and the exec team. We called time on the turnaround at the end of FY19-20. These results on an audited basis for that year 19-20, I believe, evidence that with increasing confidence as current trading plays out in front of us, and we feel ready for the next phase in the business's development. We're intent on growing, consolidating what's in front of us and developing into some new markets, but we'll cover off those points a bit later. In the meantime, I'd like to hand over to Gareth, the CEO. He's going to talk to you regarding how we've moved from to being a brand killer.
Hopefully everyone can hear me there, because I just got a warning sign that my
You're all good, sir. All good.
Thank you. Just this slide just gives you a bit of a summary of what we're going to talk about today. I'm conscious of the fact that some people on the call may not be aware of some of the history of ACCROL, but this will be the last time we talk about the turnaround. As you know, we've taken 2 years to really get to grips with this business, and this will be the last time we talk about the business as a turnaround. We'll also cover the people piece and where we're up to with the key individuals in the organisation. We are clearly pleased with the finances of where we've got the business to this stage, but to be clear, we view this as very much a staging post. This is not where we expect the business performance to stop, quite the contrary. And similarly with operations, whilst we've cut a huge amount of costs out of the business, we clearly see a great deal more to do in the organisation. Commercially, you'll see that we've improved our margins by almost 50% this year. But what we'll cover in a bit more detail is how confident we are about how we manage our margin going forward, and then we'll talk a little bit about where we see the future of the business.
On slide 3, we've got some key highlights in the financial results. As we mentioned previously, FY19-20 shows a strong and improving performance over the course of the year, albeit one that ended in somewhat unusual circumstances in the March-April emergency. Overall, you'll see revenues are very pleasingly up. Encouragingly, margins are growing and continue to grow. There's a laser focused on getting cost out of the business. That continues, although some of the big items have been eliminated already. And happily, the cash and debt position continues to improve from where we inherited. It's now down to less than 18 million at the April year end. In terms of current trading, we've experienced some choppy volumes relative to what we normally see in this highly predictable business. Slightly more sluggish growth than we would have expected, but that's more than outweighed by expanding margins and close control of our costs. The net debt is approaching 1 time to 2 times in time and profile. Headroom remains very healthy. There's more cash generation to come from both earnings and further creditor support. That is despite a continuing commitment to accelerate some of the capex programs in front of us. We're keen to expand capacity and take out further cost. I'll hand over to Gareth for slide 4.
So this slide just gives you a feel for where we are with our customer base. One of the big strengths of ACCROL is the broad breadth of retailers that we deal with. Our goal is a relatively simple one: is to deal with all of the retailers in the UK. It's not more complicated than that. We also have it's not a rule, but we try to ensure that no one customer is more than 20% of our turnover. Aldi, the year that's just gone, was slightly above that, but as we've grown other revenue across the portfolio, that sort of midterm target of ensuring that no one customer is bigger than 20% will be maintained. I think the other key point I'd raise in this slide is that we look at the market in its entirety. We don't look at the private label market. Our biggest growth comes from the brands, from Andrex, and I think that's quite an important point. This year we've grown over 14.5%. The total UK market grew just under 8%. That actually really was driven in the main by the panic buying towards the end of full year 20. So I suppose the message here is just the real breadth of our customer base that's real sets us a difference from many of our competitors.
Apologies for this glitch. I can't quite hear what Gareth's saying, but I've heard a couple of these commentaries before from him, so I'll carry on with the team slide. We have a seasoned, proven team in place. The core exec team of Gareth, Graham, and Mark have worked together for 15 to 20 years. But importantly, that team has also now operated the ACCROL business for a good period of time. The learning curve is well and truly behind us. We had a very significant piece of work to do in terms of changing up the management team. I think 19 of 21 senior seats since we arrived have rotated, but we now have the right people in the right places, and importantly, they're all practiced in their roles. We feel we've got a wide enough team now to project some growth, further growth into the business and develop into new markets as well.
Over to you, Gareth.
So this slide, we've shown this regularly to our shareholders from the very beginning, that when I joined ACCROL, what we wanted to show was a clear path back to a baseline Ebitda number of 10%. Clearly, over the last 2 years, we've seen some good, steady progress. We've still got clearly more to do, but we've got a very clear sight now of a minimum Ebitda performance of 10%. I get frustrated that people in manufacturing sometimes feel that we don't deserve to make same sorts of levels of return that perhaps a Mars bar manufacturer might be able to make. But there's clearly more to do, but we've got clear sight now with a level of return that we think is acceptable. If I just turn to this slide here, which again, this will be the last time we'll share this slide, but this is the turnaround slide that we've used. It obviously it looks reasonably complicated, but in my head this is relatively simple about how you turn around a business and how you run them. First key line is that cost base line. We've done a huge amount. We've almost halved the cost base in the last 2.5 years. In manufacturing business and operationally efficient organisations, it is a relentless approach. Every day is about challenging the cost base that we have in the organisation. Just because in our minds now we have completed the turnaround, we don't change that philosophy. That remains ingrained in the organisation at every level. The blue line on simplification is, what was key around this business was that it had some great core skills, and create great core businesses, products, sorry. But it was just too complicated. And what we've done over the last 2 years is we've taken the SKUs down from over 500. It says 120 now SKUs there. We've probably really got 80 of note. One of the key elements has been around material simplification. So we've gone from having 75 different tissue types, we now have 6. And that cost-based drive, that automation that we've put in the organisation as well, has allowed us to more than halve the workforce. The 310 number will be where we'll be at after the final automation has gone in Blackburn, which will be completed just before Christmas of this year. The third line about platform for growth is around people, is around making sure you're right individuals in the right roles. Clearly getting the backing from our shareholders and giving us the funds to be able to make these changes. And the final line, the adjusted EBITDA line, that for me is a simple a score of how well you're doing the other 3. You don't, in a turnaround and running business, in my mind, you don't start off with your EBITDA number. Those 3 key lines are what's important.
I'll just take you through some highlights on the progress we've made over the last couple of years in operational terms. A couple I'll pick out. We're very proud of our engagement levels. This is despite the attrition that we had to put through the business. We've roughly halved the headcount in the business, and some of those activities remain ongoing. But despite this, the engagement levels are extremely high. We've had an amazing level of commitment from the workforce all the way through the emergency as well. There's been some outstanding performances, so hats off to the exec team for the leadership they've provided there. Engagement levels are nice, but they also translate into real financial and operational advantage. We're seeing more output per head. Revenue per head is up very pleasingly, about 75%. A key metric we use is added value per pound of total labour. That continues to improve. We're heading into best-in-class territory in short order there. It's a key item on how we made an operational efficiency. Those efficiencies, as Gareth said, then translate into financial performance. In combination with some careful cash husbandry, it translates into EBITDA growth. There's a real emphasis on that as ultimately a key metric for performance and value. Fair to say, a couple of years ago we were very much focused on survival. We've well and truly moved past that, and now the focus is on shareholder returns, and we're keen to develop the business further in that direction.
Thanks, Dan. So the slide here on sales and margin growth, I'm just going to pick a couple of things out of here rather than just talk you through the whole slide. I think the graphic in the middle there with the white line at the top, that's the Andrex sales on promotion. That's quite important to us and quite important to the market. If you go back 18 months earlier than this, Andrex sold on promotion would have been around about 50%, 55%. It's now in the high 80s. And the yellow line beneath that is private label sold on promotion, which is still remains. We've seen the odd spike, but still remains below 10%. What we're seeing is that in different regions where brands have had a dominant position and have now been overtaken by private label, areas like Germany and France, etc., is you tend to see the whatever the prevailing brand is in that region, the final throes of their existence almost is the level of promotion that they're doing. So we continue to target that market. That's where we see most of our growth coming from. The margin growth, clearly a 50% improvement in margin in a 12-month period is unusual and clearly pleasing. It obviously won't continue at that rate. However, we continue to see a margin improvement as we move into full year 21, which is encouraging. The one area that you might not realise within toilet tissue and kitchen towel, that it's sold and bought in 3 different categories. There's an entry level, there's a mid-tier, and there's a luxury end, which obviously Andrex and products like that sit in. When I joined ACCROL, 100% of our work was in the entry level. If you look at now our mix of work today, About 30% is in the top tier, about 50% is in the mid tier, and about 25% is in the 20% is in the entry level. The margin improvement, it goes up that value curve a couple of points all the way through. But what's important is the way that we've been able to churn the work and grow at the same time. And then the other graphic I'll point to really is the top right, the size of the market. We still only have 13% of the total addressable market for us. There's a lot for us to go at. We have about 26% of the private label market, but the overall, despite a blip really with regard to COVID this year, that the private label sector continues to grow against the brands.
I'd just highlight that point around structural growth. We're highly confident the business is in a good place. Both the switch out into private label and our emphasis in the discounter channel, both hard discounters and the Germans. I think we're very confident in the rate of growth in front of us. We're gaining from the brand, as Gareth said, but we're displacing the brand partly because the high quality products we're bringing to market. I think we mentioned earlier, if we follow the Continental example, the brand normally capitulates when it gets to a 50-50 share and accelerates to a 80-20 share in favour of private label very quickly. That's certainly what happened in France and Germany. We think the UK has reached that tipping point now. In combination with that top line growth, I think the ruthless approach to cost and efficiency and margin management, it will translate into continued outperformance at the Ebitda level.
Just looking forward, this graphic here is deliberately like a tube map, but this just gives it. We use this. This is very much an internal document, but we thought it was useful to share with the shareholders about how we go about progressing the business over the next 4 to 5 years. Key to that is the red line, the hearts and minds of our organisation. So this is around every individual understanding what their roles are. We're very advanced in that. We're very pleased with where we've got to. We've changed a lot in the organisation. The blue line above it about world-class basics. We're in manufacturing, but we don't like to complicate things. This is all around making great products consistently well, giving great service to the retailers. We know that if we deliver that, we'll continue our volume growth. The purple line beneath that, markets for growth. We are in a unique position. It is unusual in the UK to find a market that's growing at +8% every year. That is rare. It's clearly at the detriment of the brands, as I've said, but you know it's something that clearly is a huge strength for us. The green line at the bottom is about sustainable growth. This is around our green agenda, buying from sustainable sources, our tissue. By December of this year, we will be buying and using 100% of our energy from renewables. We're doing that for 2 reasons. Clearly, there's a huge benefit for the environment, and the other reality is that it's more cost effective for us. So there's a real plus point for that. And then the final point, which we'll touch on towards the end of the presentation, is about Future Perfect, the line at the top. So this is about where we take the business going forward, what we feel is the future for the organisation. The team we've assembled isn't here just for us to now just become a steady organisation with an operation just in Blackburn. So we feel that there's a real strong future going forward. Just a couple of comments on this KPI deck. I'm not a big believer in having thousands of KPIs in organisations. We have 2 or 3 in each of the key metrics for us. I'll pick just 2 or 3 out of here that are clearly very pleasing for us. First one around revenue per employee. 2 years ago, it was just under £200,000 of revenue per employee. We exited this year at just over 300,000, so £319,000. Current run rate, we're close to 400,000 as a business. Other key metric, which is not unusual in big business turnarounds like this, where you have half the workforce. Our employee engagement scores are very strong. Most individuals in organisations understand that are living and breathing it every day, understand if management aren't making the right decisions. And when you start making changes that people believe in, you often see engagement scores improving dramatically. Our absenteeism in the organisation has improved enormously. When I joined, it was over 10% was absenteeism. It's now just over 2. It's about 2.1%. World class is less than 2, so we're not far from there. So we're quite pleased with where we're taking the business.
I'd just like to put some emphasis on our ESG credentials. They are real, and we're continuing to develop them. We hit some big themes strongly. Our diversity programs are developing. By way of example, we've got a positive gender pay gap. The sustainability is increasingly important, as Gareth referenced, both in terms of product and production. And we have a short-term but real target on carbon neutrality. Across the board, I think our ESG approach is developing some momentum. I'll take you on the next slide, if Mark could move it onto the cash and debt. We noted in the RNS that we've improved and extended our banking facilities through to 2023. Not only are they cheaper, they provide more availability and a lot more flexibility. This should translate into better margins as we can conduct some tactical buying on the parent real side. We expect some further creditor support to come, partly on the back of credit insurance, partly on the back of the strong relationships we have with our supply partners. But against the cash and debt management, there's been no slowdown in our CapEx program. We've funded recently an automation project that drives greater efficiency into the business. With a 2 million project there is generating annual savings of the order of about £1.5 million. We plan to bring more capacity into the business as well. We have a new machine scheduled for delivery and commissioning in the spring of 21. And a bit further down the line, we plan to make some investment in vertical integration. We would plan to have some kind of partnership on paper production sooner rather than later. This will allow us to capture some margin and eliminate cost. Overall, we're committed to low leverage. We've worked hard to get the leverage under control and down, and we won't sacrifice it now. We're also committed to accelerated investment. We think there's a growth market in front of us, and we should invest behind this business to make sure we take advantage of it. But ultimately, and sooner rather than later, we would plan to return to the dividend list, make sure shareholders benefit in the distributions that the cash benefit of the business can deliver. Just moving on, the next slide talks to some of the outcomes over the last 2 years since the new exec team's been in place. But fundamentally, simplification of a great business is at the heart of our approach, as Gareth talked about. We've got a market-leading position, we've got good top-line growth, and we think we can convert this into a growing cash profit by expanding margins and eliminating further cost out of the business, as we've shown we can do over the last couple of years. I'd like to thank some of our long-term shareholders. Our shareholders have really stood behind the business through the tricky period. I think we're focused now on paying them back in terms of outstanding performance going forward. Do you want to lead off on the strategy slide, Gareth?
Yeah. I'll just click on. So just to finish with the presentation, the right-hand side just covers our tissue business, and we see a real opportunity of over the next 4 to 5 years of doubling our size and having a real step change in our profitability. There's a market there for us to grow into. We, as many businesses, we will now look at whether there is the right M&A activity for us. It's important that clearly it has to work and fit, and as any organisation, we'll always be looking for the right sort of acquisition. We're also, as you'd expect, as a big paper buyer, about whether or not actually it makes sense for us to make some of our paper. Coming from an organisation that was highly integrated, our strategy is never to be more than 40%, 50% integrated if that was a route we were going to go down. And then the left-hand side just covers some other areas that we're starting to look at. A lot of this has been driven by the retailers asking us whether or not there's going to be any further product extension. And this is on the back of their excitement about what we've done with the ACCROL business and tissue. Some of these are easy to think about. So, we're already selling pocket packs, looking at wet wipes, environmental wet wipes that actually do degrade in water in seconds. And the way that we will grow that market is we'll look at selling that through retailers in the UK with partners we've found in Europe and beyond. And if the volume then supports investment in the back of that, that's what we'd look at. And then, the product extension, looks at the areas that there's an obvious link between tissue, so household products and personal hygiene areas. It's not something that we're going to be doing tomorrow, but as we've now stabilised the business and we're able to look over the parapet, we're just seeing what else and where else we could take the organisation.
I think just to echo that, Gareth, the key focus in the short term is executing on the growth strategy in the core tissue business. That is our front and centre focus. But we do believe we've got opportunity to continue our brand killer approach in the hygiene and wellbeing space. We think we can replicate that in adjacencies, and we have a lot of learnings in tissue that we can bring across to things like wet wipes and feminine hygiene.
Perfect. Thank you, Gareth. Dan, thank you very much. And apologies to Dan, obviously, with the audio issues that the bandwidth was causing. Ladies and gentlemen.
If it was a bit clunky as a consequence.
No, absolutely fine. Thank you. Thank you, Dan. Ladies and gentlemen, please continue to submit questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review investor questions submitted today and address those that were pre-submitted, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your InvestorMeetCompany dashboard. And before we actually go into the Q&A, I'd just like to remind investors that feedback is important to the company. And immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Gareth, Dan, obviously we had 11 questions that were pre-submitted by investors ahead of today's event. So perhaps if I can throw these at you, and then perhaps we can look at any questions, time permitting, within the Q&A that's come in today. So if I throw these out, and I guess between you guys, you'll take the ones where it's appropriate. So the first question that we have is, do you respect preemption rights? I note that you have a new joint broker, which prompted me to ask the question in the event of a placing in the future.
Speak as a private investor myself as well. We're very keen to respect preemption rights. We obviously take advice from our advisors, and as you pointed out, we've now got a joint broker as well to kind of expand our engagement with investors. So we take advice from them on the appropriate structure for each transaction. I think, and evidence of our approach here was the fact that we pushed through the open offer on the fundraising we did in May 18.
Perfect. Thank you very much. Second question is markets. What new territories do you hope to enter into the future?
I think in terms of territories, we're very much focused on the UK. I think that this is a product that doesn't travel well, or it certainly doesn't travel cost effectively. So our immediate opportunity, we believe, is executing in the UK and product by way of product extension, widening our market in the UK.
Sure. I do notice that obviously a couple of the questions overlap with the live questions. So obviously we're mindful of not duplicating questions to you. The next question is supply of paper, problems before, but how and why would it be stronger now?
We've put a lot of effort into developing our supply relationships. The bulk of our parent reel purchasing comes from outside Europe. So a sort of ancillary question around Brexit risk is we think it's mitigated largely by our purchasing strategy. We buy from a number of points in the Middle East, Turkey, Egypt, Morocco is also a supplier. We get some supply from Portugal, so that there's a breadth to our supply base that we didn't previously have. I think there's a credibility that Gareth and the new team have with those suppliers because of the way we've spent time with them and the way we've kind of honoured the commitments in terms of volume and price that we've bought through. So we're very focused on making sure we have the right supply partnerships. One bit of evidence there is we have a close relationship with a key supplier in Turkey. We've secured an exclusivity on a new mill that they've put down on a super soft substrate, which we think gives us a leading advantage in the market at the moment as well. So we think we're in a good place now with our suppliers, but it's been a bit of shoe leather spent in terms of getting out and about amongst them.
Thank you. A question around new automation created. Will we hear more about how the new lines are deployed?
So there's a couple of separate topics there. We've put a £2 million investment into our Blackburn plant. In the last week, it will be commissioned over the next couple of months and operational before Christmas. It generates about £1.5 million of cost savings by automating the end of line. So we've robotised the end of line and put in some automatic conveying machinery as well. And a side benefit of that investment has been to increase capacity. The production bottleneck was at that end of line. And so we've probably got about £10 million of incremental capacity coming through from that investment as well. Separate to that is a further machine investment that we're likely to make towards the end of the financial year, or certainly in the spring 21. We think a machine normally delivers 15 to 20 million of incremental revenue potential, and we'll probably put that into our Leyland plant in spring 21.
I think that's kind of addressed the next question, which is tissue making machines. Any plans to own your own one? I guess you've just touched on that.
Yeah, I think Gareth touched on it. You know, we would consider some kind of investment or partnership opportunity as well with a paper making facility. There's certainly cost and logistical benefits that we would get from having some degree of our supply brought in house, but as he also said, we would never move to a fully integrated position. We think the nimbleness of the business and the ability of the business to access the parent reel market globally is important. It gives us a cost advantage as well.
Thank you. The next question, I think what we'll do is we'll merge this. I think there's a couple of similar questions in the live Q&A around acquisitions and opportunities. We've got a question here. Why have you appointed a new joint broker? Again, obviously, I'm mindful of things that you can and can't say within the realms of.
Yeah, it was certainly no criticism of our existing broker. I think Zeus has done a good job standing by the business through a difficult period. I think we just wanted to widen our engagement with our investor base and bring potential new investors into play as well.
Okay, thank you. You know, I guess I'll come on to the question number 8 in a moment, but next question: are there any particular new areas you are looking to grow the business within personal hygiene and household products, and would you look to do this organically or through acquisition?
I maybe should let Gareth answer that, but the immediate answer is yes. You know, we touched on adult incontinence, fem care, and wet wipes. We're primarily looking at it organically. I think that there aren't necessarily natural acquisition targets in front of us on that front, but we wouldn't invest ahead of proving in demand. So with ideas on a particular wet wipe product that's environmentally friendly and also highly convenient because it can be flushed. We think it's a market-leading product that would give us a USP in the UK, and we can partner with a mainland European producer, bring the product into the UK, and then potentially lay down manufacturing capacity here as and when we've proven the volume justifies it.
The only thing I would add to that is, Dan, which we said earlier in the presentation, if the right acquisition came along, and we're an organisation that is looking at a variety of different things. As Dan says, we have tended to invest on the back of sales we already have. So, if the right sort of investment and acquisition came along, then that made sense to us, then clearly it's something that we would consider.
Thank you. Just the final two pre-submitted questions. What are the processes for managing foreign exchange risk?
We typically buy 3 to 6 months forward on our purchasing requirement. So our key input is obviously parent real. It's priced in dollars, so we cover that 3 to 6 months forward. We don't do it further than that. I think we would be using our balance sheet to speculate if we landed further forward than that.
Thank you.
I think it's not about, well, it is about currency. I think the important bit, I've run and involved in organisations for 20 years that have had currency and raw material input costs. I touched on the commercial strength of the organisation. We have this radical idea that we put prices up, and we've shown that we're successful at doing that. If you have a good product, you have good service, then we are discussing pricing with customers on a weekly basis. So that's how you manage your whatever your raw material cost increases are, whether it's currency or whether it's tissue pricing.
Thank you. And finally, how do you, I guess this obviously corresponds, how do you look to increase market share within your existing products and markets?
I think we have a natural growth in the business as the Andrex brand decays. Premium private label fills the gap, and we believe we're the market leader in premium private label. So as long as we can maintain and improve our product quality and displace the brand further, we think we offer a better value product and a better quality product. So that's driving share. It's also picking the right horses. We partner with retailers across the board, but we've had a lot of growth out of the discount channel, but increasingly benefits in the grocer channel as well. So making good strides inside the big four grocers as well.
Thank you very much. Well, look, I think that that's dealt with the questions that were pre-submitted. Obviously, if I could draw your attention on the Q&A tab, obviously we've had a number of questions that have been pre-submitted by investors. Obviously, I guess as an experienced, investor, there are things that you can't answer. I know there's a question: are you doing a placing within the next 3 months? Obviously there's questions within this that you can only respond to within the confines of being a listed company. Could I hand back to you, perhaps, just to select the questions? We've got about 5-10 minutes, because I know you want feedback, perhaps to select a few of the questions, and just to remind investors that all questions will be reviewed by the company, and where appropriate, responses will be published. So if I could ask you just to read out the question, and then perhaps a response where it's appropriate, and then I'll take back from you.
Sure. I think Nick J has asked about the current environment offering any M&A opportunities. I think Gareth touched on this as well. It's something both Gareth and I are familiar with. We've led acquisition and integration programs before. I think there are potential opportunities in front of us. We would consider the right acquisition at the right time. Probably restricted in what I can say further than that. The next question talks to market share. I think we covered that a little bit earlier, so I'll jump down to JD asked about gross margin growth. I'm going to throw this at you, Gareth. Gross margin growth has been strong, but are you at peak levels now, or is there further scope to go?
Well, I think we've covered that in the presentation about we saw a slide on our route back to 10% returns. We view 10% returns as our base point. We don't see that as the top of the mountain, so to speak. I have run manufacturing businesses that have made good, strong returns above 10%, and there is no reason why. Our aspiration is to drive towards that. So the easy answer to your question is no. We don't see this as a peak.
Daniel C has asked about bringing in more investors. What size of investment we're looking for? I think sort of pick apart that question slightly. I was talking about investors interested in investing in the existing business rather than any new issue there. So it's not a case of size of investment. I think we believe we have the balance sheet to make the core organic investments that we need to make at the moment. So the investment in the new machine and the investment in the automation project is happening from within internal resources.
Perfect.
And Imran K, I think Imran K probably knows better than to ask a question about confirming a placing.
Thank you. Dan, Gareth, thank you very much indeed for updating investors. Now, I think that takes care of perhaps, if not all, most of the questions that have been submitted during the live event. Perhaps I could just ask you guys to maybe just wrap up, and then obviously we'll redirect investors so they can give feedback.
Sure. I suppose my concluding remarks would be around the turnaround being behind us. This is not a business in any kind of distress now. We have the full team in place. The financials are on track. Current trading is sound. We've got improving trajectories in all our key metrics. So we believe this business is now a platform for growth. We've got opportunities for consolidation, opportunities to grow into adjacent markets. So we believe there's a very interesting story that can drive returns for shareholders. Overall, I'd like to thank everybody for their support and look forward to reporting on progress in 6 months' time.
Perfect. Thank you very much indeed. Could I ask investors please not to close the session, as you'll be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear in front of you. If you accessed it via the link sent by email, you'll be asked to log in to submit your feedback. On behalf of ACCROL, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you once again, and good afternoon